thanks everyone for coming and AJ Bell for setting this up. I got to clarify a couple of things right off the bat. You're probably here for Duke Royalty and you see Duke Capital. We are the same company. We just went through a rebrand, and this is why I want to come and tell our shareholders about it. I've met a couple of shareholders already. The second thing I got to clarify is, despite my Canadian accent, we are listed in the UK. Okay, so bear with us. I'm Neil Johnson, the CEO. I'm joined by Charlie Cannon-Brooks, our CIO, and Marcus Oldsberg, that will be here after as well, that we'll mix and mingle. And listen, we only have 20 minutes. I'll try and do it and before that, with lots of times for questions. So again, let's get into the presentation. And AJ Bell had the two alternative finance companies right at the front of the presentation. So that's probably where we will be the only similarities here. Duke Royalty, we actually play in the sector above time finance, so we're the lower mid-market, as we say, so we're not SME financings. Our average loan or investment is over £10 million. But just some of our stats here. We've admitted in 2017, so we have 7 years. We have 15 current partners. We'll talk about them. We have £200 million of current capital invested, and most of that is equity. About 70% of that is equity. And we pay a very nice dividend quarterly, and our current annualized dividend yield is 8.5%. We've returned since 2017 actually almost 18p of dividends back to our shareholders, as a total of £46 million. So you can see that we're committed to giving dividends and consistent dividends, and a well-covered dividend as well as we grow our company. The three boxes at the bottom here really are investment thesis, and what we have from day one wanted to show investors and prove to investors. One is capital preservation. We're downside protected. We'll show you how we invest, but that's pillar number one. When we first admitted to AIM, we put a dividend on the first quarter, and we certainly have the dividends and the track record of dividends. As well, we want to talk about why we're not just a credit product or a debt provider. We are a hybrid, and we talked about corporate royalties, and some of you might have heard me speak before. Corporate royalties is now hybrid capital. So if just erase your mind from corporate royalties. We're going to talk about hybrid capital here, and I'll tell you why. But the growth in our business will come from the exits, and we have a long-dated corporate mortgage for 30 years, and what we want to invest in are long-standing, profitable private companies that have a need for capital but want to retain the control of their companies. So they're not willing to sell their company, but they need capital. And we'll show you why people would take us over a bank financing, and there's other lenders out there and other ways to have capital, but we have a very unique position in the market. And for business owners, we have a very great proposition for them. To put this into context, this is the rise of private credit. And you can see that when we started, a couple of years before we started, it was only $500 billion globally, which is tripled. Now, we play with all other forms of debt, with mezzanine debt, venture debt, and of course royalties. But the dark blue piece of the pie is actually what we have been doing since inception, which is being a direct lender, and that means our company and our balance sheet will lend our money lower, like business owners for a long period of time. And that means we can be flexible. We can have the capital that has similarities between debt and also private equity. And we're long-term partners with our business owners. This slide, and I won't go through that slide, but basically direct lending is a very good form of and has outperformed other forms of debt. But I really like this quote from the BlackRock woman who says what direct lending does. And when you've heard us talk about and you've read what we have on our website and every year in our annual report, we talk about the extensive due diligence we do up front. We're almost like a private equity that we do a lot of due diligence. We use McKinsey & Company to give us data about the industry that we're going to invest in. So it's a really upfront, extensive process, intensive process. We also have senior secured loans, and this is why direct lending is resilient in good markets and bad markets. We're senior loans. We monitor. We've said this from day one. We get monthly management information. We're on the boards of these companies. It's really like a partnership, and that is having a strategic partner. We've always called them royalty partners, and that's the way our business owners think about us. So we're really right in the sweet spot of direct lending. And not to belabor the point, but the private credit, lending is only part of our solution. We have a lot of attributes, just like private equity, and so we're never going to have thousands of little loans. We're never going to have give businesses that we give money to that we're not actively involved in. So it is a relationship-based transaction for the long term. Our average loan, as you know, is 5 years or less. You may have amortization over those 5 years, but it's a short-term loan. Our loans, our corporate mortgage, as we call it, is 30 years. That has not changed, and that's an amortizing 30-year loan, just like your house, and you're paying every month. That's just like paying Duke Royalty. I said it, Duke Capital. Sorry, you'll catch me. Duke Capital is amortizing, paid every month, and amortizing. Now, just like your house, you don't have to live in your house for 30 years when you take out that mortgage. You don't have to take this capital for 30 years. There is in the hands of the business owner is the control of when they want to refinance us out, and that is very different from everyone else. First of all, you can pay. You never have to pay back the capital in all one slug, so there's no bullet repayment. You're paying it just like your mortgage over a long period of time, and you can refinance this out in the hands of the business owner, which those are two things that are very unique in the market. And instead of saying a corporate royalty, what we've always done is have two products: a fixed rate 30-year amortizing loan, which is senior secured, which is secured on the assets of the business. And then how we have always got that royalty, that revenue linkage that we cap and collar, is through this variable rate preference share. And so that's our credit product. Now, when the business owner wants to buy us back, and this is all negotiated up front, there's no hidden gotchas or anything. We negotiate what we need when, and this is the kind of the private equity part of the equation, we're going to be partners. Now, when you want to buy us out, that's fine. It's in your hands as business owner. But we're going to want, because you took our capital, we're going to want a return, and our return includes exit fees. It is a little bit of a deterrent, to be honest with you, because we want to be having long-term relationships. So they're locked in for 3 years unless they sell the business. And then after that, there is an exit fee that right now averages 20% of the capital that we took. Now that's because what that represents is really the partnership that we have, and it's in the hands of the business owner, and that is really, instead of taking a majority of their company, we have that, and it's fixed. More and more as we go through what we're doing and partnering with business owners, we'll ask for minority equity stakes. This is where we fit, and the revenue of 10 million to 50 million pounds, which we call the lower mid-market, owner-operated and family businesses. We're not doing venture capital or venture debt, and when they get too big, we probably will be refinanced out because they will sell to a private equity. That's probably, that's the ecosystem of this very, very large private credit and private equity industry. What's the investor highlights, and what do we promise, and what have we delivered? Highly predictable revenue streams. We'll talk about that. I've got a slide on that. Exits, and we'll talk about our 6 exits. We have a unique exposure to these companies. These are profitable private companies, won't go public. They're not going to go public themselves, but you can get a basket of them buying Duke Capital. And we have a very stringent investment criteria. So we're trying to get, and we have delivered for the last 7 years, attractive risk-adjusted returns. We're never going to blow the market out of the water, but we're going to protect your capital. So, and that's the key to how we invest. We have some great shareholders, including AJ Bell, on here. So this is great. We do cater a lot to the public and the retail investor. We do a lot of these type of events. But we've been backed by some of the biggest investors in the world, as well. Our senior debt is Fairfax, which is a global insurance company. And critically, I'm a big shareholder myself. Charlie's a big shareholder. We've invested every time in every round and seeded the company with our own capital. So trust me, we're very aligned with the shareholders because we put our own money to work. And this is the reason. We're not all things to all people, but management buyouts, and if you're acquiring, buy and build, if you're business owner wanting to buy more companies and use our capital as acquisition capital, we have a very great proposition for you. And you're gonna 10, 20, 30 times your equity value. So when I say you got an exit fee of 20% of the capital that you do that, it's much better than trying to sell your company or have a private equity partner that will take all of that upside. So we limit our upside, but we protect our downside. And for the interest of time, I won't go through all of that, but we're doing industrial and services business. We don't do startups. I think you get the picture. Well, you will when I show you this. These are the actual companies that we've invested in. There's glass manufacturing here. There's a big sign. There's a U.S. sign manufacturer on the side of stadiums. That's what they do. Jim, his dad started the business 30 years ago. We have a whole bunch of things, and IT services. We have care homes for adults with disabilities and youth. So I think that's a positive. We started out by diversifying the industries, the geographies, and so we're not tied to any one commodity or any one geography. But what's more important is there's 15 of those, but there's 63 underlying companies, as I said, acquisitions. So we have operating businesses that total 63. So that's even more diversification than the 15 companies at the top. These are our exits, as I said. You know, we get a bump of our IRRs, or our IRRs have the top and the bottom. We'll have a glass of wine, and we can talk about why those are plus and plus 200 and minus 1.4. But it does speak to the fact that we are shepherds of capital. We protect our downside, and if you get more than just the corporate mortgage and the pref share, we can build from the exit fees and then the equity stakes, increase the typical returns that we can get. This is one of my favorite slides, which is our quarterly recurring revenue. The black represents when we get buyouts. As I said, we get upticks, and those are our revenue spikes, the one-time spikes. But what we like is to see this recurring revenue line keep growing, and this is our percentage of our operating costs. So there are 3 new people in the business. So our operating costs went from 10% of our recurring revenue to 11%, and that's a 30% increase in our headcount. So you know, it is very very profitable. We have a great cash flow. You know, that means that our cash flow for our OpEx for the year is paid by February, and the rest is going into our bank account. So we're very proud of this, as you can tell through the last 2 years of what we've been living with post-COVID. Not going to go through this, but just to say that, you know, out of the 200 pounds that we have invested, 74 million has come back through the cash return from our investors to date, so 37%. So that just shows you the power of what we've created. And the other stat that you might like to know is that this 200 million pounds is 30-year loans. That will equal, if every one of these loans went to term, which of course they won't because they will be recycled, but that's almost £1 billion of revenue that we've created for our shareholders. So it's a very robust, a very long-term model. Again, the balance sheet. Just say we've increased the NAV over the years. We have 40 million pounds of exit fees that are contracted, as well as that over that 200 million pounds. And just the last slides, and I've got 3 extra minutes, so this will be good. Yeah, everyone talks about origination. Everyone talks about we need deal flow. It's absolutely the lifeblood of our business. Marcus is devoted to origination. So we've actually implemented, and Marcus is leading this, the CRM. So we have 2,000 people that know who Duke Capital is. We touch them and reach out to them on a regular basis in order to get new deals. And our deals, when we get through this, and I'm proud to say that this slide, this process hasn't changed since inception. You know, when we get a deal to analyze internally, we analyze it, but we have an independent investment committee, that really is a check and balance. And our investment committee has royalty pioneers on it. Jim Webster is our chairman, a guy who founded a $1 billion private equity firm. So very smart investors, and they challenge us to ensure that we're doing what we say we're going to do. And it's one of those things that, you know, we have to sing for our supper. And then after that, it goes to our board, our PLC board, to also get approval. So I think over the last 7 years, and I appreciate everyone who's a shareholder here and have followed the Duke Royalty story, which is now Duke Capital, to really you know, grow and expand what we do. But we're not going to change the best part of Duke Royalty. We're not going to change the way we invest and who we invest with, and that partnership with businesses. And we just are recognizing that there is a huge private credit space that we're you know, changing the messaging of our company. So thank you very much.
Thank you. That's great, Neil. Thank you very much indeed. Again, if you have a question, please raise your hand and wait for the microphone to come over. No one's going first. Gentleman here, please. Chris, you have the microphone.
Thank you for a very good presentation. There are a couple of things I picked up from it. The first is, in common with many people, I'm quite fond of dividends, and clearly you've been a strong dividend payer. You mentioned preservation of capital, and I'm keen on that too. But I note that if I'd invested 5 years ago, I would be 20% down on my entry point. And if I look at a graph of your share performance over the last 5 years, I don't at the moment have access to anything longer. There was an inevitable COVID-linked slide into the abyss and climb back out of it. But if we look at the post-COVID time, the trend is still downwards. And one of your co-directors made an investment 12 months ago, I see, roughly, and presumably did it with a position of greater knowledge than I would have, and is marginally ahead on his purchase at this point in time. Those features don't make Duke Capital immediately attractive to me. What could you suggest to make me feel differently?
Yeah, it has to do with the risk-free rate. The last 2 years, we've seen, you know, if you put money in the bank account, you were getting zero. So our dividend yield at that time has always been between 5% and 6%. From 2017 to right before COVID, the stock went from 40p to 50p. You know, COVID, you know, everything went down, but we went from 30p back up to 45p right before the war in the Ukraine. And the British government increased the interest rates 14 times in a row, from 0 to 5.25. Now, when you have when you put your money in the bank and get 5% interest, you know, Duke Royalty unfortunately is going to have a higher dividend yield than having money in the bank. So our dividend yield has now trended up, which i.e. putting pressure on the stock to between 8 and 9%. Now, if we all think that the interest rate is going to go down, that 9% interest rate becomes much more attractive if you're getting 2% in the bank instead of 5%. And so I think that will trend down. There's buyers and sellers of our stock every day, unfortunately. I just wish the buyers would show up and not the sellers, because that would alleviate things. I know that the retail really is a big buyer of our stock, but you know that we've done everything we can. We can only control what we have in our company, and I think it has a lot to do with the relative positions of our where else you can get a dividend yield like ours.
Question here, please.
Yeah, I also say thank you for the comprehensive presentation. You've mentioned that you've got your own money in the company. What's the insider shareholding percentage?
It's 4.5%. It was one of those things. It's over 4%. For all the directors, yeah.
Question at the front here, please, Chris.
I had a question. Thank you for the presentation.
Yep.
Had a question about the capital allocation decision making, because you're paying a very high dividend, but you have regularly issued shares, which makes the dividend progressively more expensive in cash terms.
Yeah.
What's the rationale behind that? And then the other question, which is a bit more technical accounting, maybe for the CFO. If these are
Yeah,
corporate,
definitely.
if these are amortizing corporate mortgages, why are they not on your balance sheet at amortized cost? Why do you fair value the assets? And similarly, when you look at the cash flow, it shows cash coming in. Presumably part of that cash is cash interest revenue, and then the other part is repayment of principal. So should that not be split on the cash flow statement as opposed to being one lump?
You know,
I'm a shareholder, by the way.
well, the short answer to that is we have the investments are fair valued. Okay, so we have it's not a loan book. So we have we do a 30-year model and value, and it has to go to zero, and it has to start at our cost. And because of the revenue linkage, we actually value these companies that are going to go higher. They're going to pay us more. So it's not a loan book. So the value of the companies, actually, the value of the investments, based on our model, should actually increase slightly to the top of year about 17. And then, of course, it has to go to zero by year 30. And that's because of the revenue linkage of and the embedded growth that we project. And actually, our long-term, our 7-year, it was on the slide, our 7-year average is 3.4% that we've increased, like our annual adjustments, but 3.4. That's right. Yeah, it goes up. So we have growth embedded in our cash flow, and our long-term models are only 2%. So we're actually beating our long-term models. So that's why our value goes up.
I think we are out of time then. Thank you very much indeed, Neil. It's a really
Okay.
interesting presentation. Thank you.
Thank you. We'll be around.